Now, there is not much correlation between Wall Street and India right now. And even if funds were to flow out of Wall Street, India may not be a direct beneficiary since it would potentially and otherwise attract other pools of capital aimed at emerging markets in general or India in specific. But to get a sense on how portfolio investors were looking at India at this time and the sense of these larger pools of capital and where they could go, I reached out to Arvind Chari, Chief Investment Officer at Q India UK, an affiliate of Quantum Advisors in India. Arvind is based in London, and I began by asking him how he was looking at or seeing things right now.
A lot of things have happened, Govind. As you've realized, the market is buzzing. Too many things are changing, and it looks like it is fundamental reset of, some may call it global world order, some may call it global geopolitics, but I'm focusing on investments. And I think there is a very clear reset in the way global investing happens, and it will lead to rebalancing. And we will see aspects of that play out. And the reason I made that comment is investment, as Manmohan Singh very famously said in July 1991 after his budget speech, investment is an act of faith. Right? People make investments on a basis of faith and trust. And if you look at the US, has been the largest economy, has the largest markets both in equity, bonds, and in private capital. And the reason people invest in the US, because there is democratic order, there is rule of law, there are institutions both in the financial as well as in the legal setup. Investors are, find it trustworthy, and they know that making those large investments into the US and the other markets will ensure that their investments are always taken care of, and then there are rules and regulations to support it. And I think some part of that has got impacted, not for everyone, but if you're a Canadian investor or if you're a European investor, given what has happened on a geopolitics basis or against the countries in terms of tariffs or security, it is a fundamental reset. And these are large investor pools, right? So I'll just give you data on it. As of June 2024, this was the last time the US Treasury released that data. Foreign investors owned about $31 trillion in US in public markets. 17 was public equities and 14 is in debt. That's a sizable amount of money that is invested in US public markets. And if you add private investments, so the global private capital is about 13 trillion. And the estimate is that about 60% of the 13 trillion is invested in the US. And if you assume that a lot of that is foreign investors investing in the US private equity, venture capital, real estate, and infrastructure segments, these are sizable investments invested into the US. And the reason we said there's a reset and rebalance is geopolitics and the way countries think about each other, or where the corporations think about each other, or investors think about each other may have changed, especially for a few countries that I mentioned. And they will think about, what do I need to do? Do I need to have so much investments? And in general, especially in the last 15 years, given US's outperformance against Europe and other advanced economies, both in economic sense and in the market sense. And it was, of course, driven by Max 7, as we call that the tech boom. So global investors are over allocated to the US any which way. So if I look at one metric, the MSCI All Country World Index, which is the country weightings of different countries in the MSCI World Index, US used to be about 40-45% 15 years back. It is now closer to 65-70%. So it just shows outperformance, which means investors who are passively invested or use that as a benchmark are also over allocated to the US. And this will all get to a rethink in terms of, do we need so much investment in US? Is it at risk not from a market perspective, but from a fundamental perspective of risk of my assets being impounded or my assets being taken away, or will my homes or will my real estate assets will be honored? So there will be a reset like that. And of course, then there is a financial market aspect saying that if US actually goes and installs all these tariffs on the world, will it have an impact on the economy and will it go into recession? And we are seeing some of it play out. So this is the reset and rebalance that I'm talking about. And this is where we are in terms of what investors are thinking, and whatever little conversations that I've had with some of these global institutional investors, they are thinking about this. Whether they've acted on it or not is a different question, but they are definitely thinking about, should we have so much allocation to US? Is that changing from a reset perspective or from a market perspective? And then what do we do with that money? Like, where do we go and invest that money?
And people like Chris Wood, who've clearly said that they want to sell America, I mean, not all of it, I'm sure, and invest more in India, and have increased their India weightage in recent weeks. How are you seeing investors? All of this doesn't mean a flood of money or a fresh flood will come into India, but what is the underlying signals if so?
India should be a very, very clear beneficiary of this. Because India has large markets. India's economy and the public markets and the bond markets are large enough to absorb a lot of that capital, which is as allocations are moving away from the US, for example. And second is from a geopolitical perspective, India is kind of the friendly country. India is not a threat to any nation. India also has the same aspects of democracy and rule of law and institutions and the legal setup, which will ensure that investor can invest with faith and ensure that the capital is always protected from rules and regulations. So that being the case, that India should see reasonably large flows. So if I just go back to the number, if the total amount of investments into the US is say about 40 trillion, and even if 10% of that comes out of the US, that's $4 trillion, right? And if India is even able to get 5% of that 4 trillion that comes out of the US, that's $200 billion. That is sizable in terms of size. Now, whether it happens next year or 3 years or 5 years, we don't know. Whether it happens itself is we don't know, because most of the money might just go back to home countries. So Europeans will take it back to Europe, Japanese will take it back to Japan, Canadians will take it back to Canada, and maybe keep it there till the time they're able to see what happens in the way the world is changing. But I'm pretty sure some of it will get reallocated. Emerging markets might get a reallocation. If the general tendency is that a dollar is going to depreciate, then emerging markets tend to do well in that period. So you will see those allocations. I think India will clearly be a very, very big beneficiary. Technically, as I said, the number, like this is my math number and it's an arithmetic back of the envelope number, but it is sizable for both public markets in India, equities and bond, and in private infrastructure real estate. Have we seen that yet? No, it hasn't been any meaningful manner. Maybe some of the flows that we're seeing is just allocations to emerging markets increasing and India is getting a share. I don't think we are getting any large India dedicated mandates or people are thinking, but I would believe that will happen as money goes back and people rethink about global portfolios, and the fact that India is already a very large part of the global economy, 4-5% weight in global market cap, and investors are underallocated. As I've told you in our last talk, global investors are less than 1% allocated to India on their overall portfolio basis. So that has to change, that has to increase, and maybe we have one more very big tailwind for India in terms of a global reset and a global rebalancing of portfolios.
So we've also encountered a new local geopolitical risk. We had a deadly terrorist attack in India, following which there is some question about whether there could be an escalation. Either ways, how would the markets see this in your sense at this point?
It felt like yesterday's move that we saw, the market's already making some risk premium adjustment to an eventual, and because we don't know what the Indian response is going to be. And we can only go by past history, like Kargil was one episode, and then post 2008 was a very different way that India reacted to this. There was a lot of covert and a lot of, at the geopolitical level, we seem to have done something. And then we had Uri and that surgical strikes and what happened in 2019. So the markets is going to price it accordingly in terms of, what could be the actual impact. If it gets a very big escalation into a full-blown war, there will be impact on the markets, on all currency, bond, interest rates, and in equities. But otherwise, if it's a limited escalation and it's over a period of time, I think we will be able to deal with it. Also, what has happened is, given the fact that foreign investors have been net sellers in India over the last 6 months, it has changed in the last 10, 15 days. But on the last 6 months in September, they've been net sellers. And I don't think there is much larger selling from their perspective. So unless domestic retail investors panic from this escalation and they turn to be big net sellers, for a limited escalation, we should not get a very, very big impact. If it gets big one, then I think this aspect of money coming into India will take a pause. They will wait for this to play out and then make large allocations. So we'll have to wait and watch how India responds to it. It is a live situation.
Arvind, thank you so much for joining me.
Thank you so much, Govind. Thanks for having me.